If you have a mortgage, you've probably heard about offset account and redraw facilities. They seem pretty similar, but they have very different tax consequences. In this video, I'll explain the common mortgage mistake that could cost you over $100,000 in additional tax. And make sure you stay around to the end because I'll share a tax tip that could save you $100,000 in tax. Let's get into the video. Paying down your mortgage can be a safe and often effective strategy. And there's two ways to do this. Firstly, by simply paying down the loan with additional repayments. This reduces the amount that the interest is calculated on, and in doing so, it creates redraw. Or secondly, by putting additional funds into a linked offset account. This doesn't officially reduce your loan balance, but it reduces the amount of interest you pay because the balance that this is calculated on has been reduced by the offset account. In both cases, you can withdraw these additional repayments. Firstly, by using what's called a redraw facility. Secondly, just withdrawing it from the offset account. They seem very similar, but there's one huge difference that's often overlooked by banks and brokers who can't speak about tax. The key difference is the ATO views the redraw facility as the bank's money and the offset account as your money. This difference becomes a big problem if you ever decide to turn your current property into an investment property. In that case, you actually want to maximize the debt against your current property that's then an investment property and minimize the debt against that future home. And the way to do this is through an offset account. Remember that when you pay funds into an offset account, you're reducing the amount of interest that you pay, but you're not actually reducing the loan. So when you buy your next home, you can simply take those funds out of the offset account and put them into your next home, either by paying a bigger deposit or putting it against that new mortgage. That maximizes the debt against your current home, which is now an investment property and tax deductible, and minimizes the debt against your future home that isn't tax deductible. But if you try doing this via a redraw facility, it unfortunately wouldn't work. The ATO views those redraw funds as new borrowings, so you've effectively maximized the debt against your new home, which isn't tax deductible. Extending this, when purchasing any property, I'd consider putting the minimum deposit in to avoid lender's mortgage insurance. Any additional funds that you do have thereafter, you can simply put into the offset account and you've achieved the same outcome. The basic takeout is that if you plan to turn your home into an investment property, or there's even a chance, it's best to use an offset account as soon as possible. So let's use an example to run the numbers. Let's say that you have a $1 million home, $800,000 in the mortgage, and $200,000 of cash that you've set aside for a future deposit for a home. By using a redraw facility, you pay down that $800,000 loan to $600,000 and you have $200,000 of redraw. However, when you redraw this $200,000 for the deposit for that next property, it's treated as new borrowings. And because those new borrowings are for personal purposes, there's no tax deduction for them. By using an offset account strategy, your home loan's always $800,000. The interest is just calculated on the $600,000 whilst the funds are in the offset account. When this property becomes an investment property, the $200,000 is simply taken out of that offset account, so the interest again is calculated at that $800,000. This is $200,000 more than the previous example. If your interest rate is 6.5%, that's $13,000 every single year of lost tax deductions. If your income's $150,000, this is additional tax every year of $5,070. So if you hold the investment property for 15 years, that's around $76,000 in additional tax. The longer you make this mistake, the more difficult and expensive it becomes to fix. So it's crucial you get it right sooner rather than later, ideally before you actually pay the deposit on that first property. The only way to fix this, unfortunately, is to literally sell and rebuy the investment property. And this of course results in agent fees, legal fees, and stamp duty. These costs can vary, but let's call it 8% in total. As large as this is, it can actually make sense to sell and rebuy doing this strategy. So this situation shows how a redraw can actually cost you over $100,000 in tax. But there's another side of the coin where using a redraw facility can actually save you over $100,000 in tax. It's a strategy called debt recycling, which involves turning your non-deductible debt into tax deductible debt. If you're an Australian with a mortgage on your home, or you might in the future, I highly recommend you check out this video. Just click the link on your screen now. It's my favorite tax strategy for homeowners and have many customers saving tax doing it. So that's about it for this video. If you have any questions, feel free to post them in the comments. Otherwise, thanks so much for watching, and I'll see you next time.